Thanks, everybody. Thanks, Louis. My name's Marin Katusa, and I run the energy side. And I'm going to give you a different perspective. This is a part two or an extension from last year. How many people were here last year during this talk? A few of you? Okay. So what I've done is I've modified, changed, and from my own experience, we do quite a bit of buying and selling. So don't worry about copying this down. What I'd really like you to do is just truly listen. What I've learned when I was in the education program and then teaching at the university, you really absorb less than 5% of your notes that you're actually writing down, and then people go back and study. Just try to absorb it. This is all going to be on the website, so don't worry about missing a note. This will all be there for free on the website. Now, why I want to focus on buying and selling strategies, I don't think that there's ever been a time in the resource sector where so much money is managed by so few people. And there's a conclusion that I've coming down called the trigger effect, where because these junior resources, something can happen. The selling of one or two funds can really change your value in one of these junior positions. And what I call a junior is anything under $1 billion market cap. So we're going to go through these strategies. Buying and selling, basically, there's a 20 strategies checklist for both buying and selling. Number one, how many people heard Warren Buffett's 2 rules, don't lose money? Number 2, don't forget rule number 1. It seems so simple and but the reality is this month I'm publishing a statistical analysis of Warren Buffett's performance. And when you really look at it is, in a bull market, he's good, but he's not as good as other guys in a bull market. Where he truly excels is he doesn't lose money, okay? And risk mitigation in the junior resource sector is the number one thing. This past, in the last 30 days, we've taken Casey-free rides or closed positions on 4 companies, which is pretty significant considering we only have 10 in our portfolio for the energy. So if you ever have a double, just discipline. We've published a formula on June 15th of 2008 was when we announced and published this for the first time. We looked awfully wrong for the first 3 months. We looked fantastic 5 months later. So it's all about mitigating the risk. And if you're in the private placements, this is why the warrants are so important. We'll get into that in a bit. So, for example, here's some examples just in the last month: PRD, Poseidon, Horn, Africa Oil. And here's an example where you get warrants that can give you a kicker at no cost. So private placement paper coming free trading. Well, how will that affect you? So let's pretend Louis invests in a private placement. Okay, and I don't know who Louis is, but I know that he works with some big fund or he's some broker, and the stock's trading at 50% premium to where their stock is. They have a 4-month restriction. So what you want to maybe do is, if you're having free trading paper, you want to start looking 1 month before his paper comes free trading. You might want to reduce your position, because the reality of the market is when those big players like the fund managers or the brokers, they start shorting their stock up to about 2 weeks before it goes free trading. Okay, now it depends. If it's at the end of the quarter, at the end of the month, they won't be as aggressive shorting it. But let's say if their paper comes free trading on February 17th, they'll be pretty aggressive on shorting it 2 weeks before. So you have about 1 month to, let's say, 2 weeks ahead of them that you might want to sell your position before his paper comes free trading, and then when it's oversold, you can go back in and buy again. So when you put an investment, make sure you mark down on your calendar when is the restricted paper come free trading, okay? Now that's also a buying opportunity, because if it's oversold, you can come in and make a 15-20% rebound on that. So I know a lot of guys who just do that. They focus on their arbitrage players, where all they focus on, and when a stock comes free trading, when it's oversold, they come in and scoop it up, and over the next month, when management goes out there to re-promote it, to get it back to its natural base, they start selling. Expiration of warrants. Why is this something you have to focus on? Well, let's say we invested in a financing in a dollar stock, and for 3 years you have warrants at $1.50. And now the stock, we fast forward 3 years or 2.9 years, and now those warrants come due, and the stock's trading at $2 or it's a $1.50 warrant. what a lot of people in the business will do, especially brokers or fund managers, what they'll do is short the stock and then exercise the warrant through so how many people here have done a private placement? Great, about half of you. So what happens is, if I have a stock and I don't actually physically have the shares because they're still in warrant form, you'll short it, your broker will short it, and then you exercise the warrants, and within 3 to 5 days, the management will get you the stock. So why is this important? This is a buying opportunity because you can wait till the warrants become exercised. There's a lot of pressure coming down on the stock because people don't have to write checks for it. They usually just short it, and it could be sold. But this is also, before this happens, it's a selling opportunity, because if you know there's a whole whack of warrants that are in the money, you could sell your position beforehand and buy back during that pressure, okay? So these are all interesting things that can be played both ways, and that's what makes the market. If you have any questions during this time, do not hesitate to ask, but I've got 20 of these to go through. Forced conversion of warrants. For example, if you own a stock, make sure you pay attention to the fine details. During a bull market, a lot of the companies will get away with getting the financiers, because remember, financiers, brokers, investment bankers, they work on something that's nicknamed in the business B's and fees. They work for broker warrants and fees. Usually it's like an 8 and 8 or something like that. So what happens here is, if in a bull market, let's say the stock trades, you do a dollar unit, using an example, you get full warrant at $1.50, but if the stock trades for 20 consecutive business days at $2 or higher, on the close of the 20th day, management can force convert the stock, and what happens then is there's going to be a lot of pressure on the stock. So Africa Oil was an example that we were in, where there was a forced conversion of warrants. Okay, so that's an example. So if you hold something like this, you have to pay attention on your calendar, and it's quite easy to put these now in the Google Calendar, or you can have programs. If you have an advanced level 2 program, you just input these dates on. And do you want to be holding on till the 19th day to sell, or do you want to maybe hold on to the 10th day when management are really promoting it and getting people and creating excitement in the stock to raise the stock price and to hold it there? And then when the pressure comes down on it, when people short the stock, remember number 3, they're going to short the stock to exercise their warrants to come up with the money for it. You want to be out before that hand. So you got to pay attention to when the warrants are expiring and also the date of forced conversion warrants. These are two different things. Now here's another thing. Options from management or consultants. Well, why does this matter? Well, options have about a 5-year expiry, all right? So hopefully, if you've invested in a good story, these options should be significantly in the money. So for example, if you take a little junior that wanted to be a copper producer, well, 5 years ago, they issued 60-cent options. 5 years later, the stock's trading at $6, $7. If the management do not exercise these options, they're worthless. Well, you know that management will exercise these options. Now, these management teams, not all of them are necessarily a Lucas Lundin or Ross Beatty where they can write a check, plus there's a tax consequence to these options. So what they usually do is they sell a certain percent of these to pay for the option exercise price and also the tax consequence ahead of time. So that's also going to be a significant amount of pressure on the stock. So you want to pay attention to these little things. And you'd be surprised, why is this one very important? Because big fund managers pay attention to this because they want to see what percentage of the options that these presidents and the CFO and CEO and COO are selling. And then remember the trigger effect that I talked at the beginning. There's never been a time where so much money has been managed by so few in this business, and they see the management start selling, it can cause a waterfall effect. So you want to be ahead of the management's selling of the options. Yes, sir?
Where do you find that information about the options and warrants?
Well, we publish all that information. You know what I call it, the Casey box? I don't know what you call it. The beginning of every recommendation. For our own investments, we keep track of all this, and we publish that but we don't publish it on companies we don't recommend. So if you're investing in something or doing due diligence in something you don't, that's all on CDAR. That's a free website where all of the public information, it takes a lot of time to do, but if it's a company that we're following, we do it for you. That's that first box that shows the cash, the options, warrants exercise, and has the date and the price and all that. So, but if it's not a company we follow, it's on CDAR. And for the Americans, it's SEDI, so SEDI. And CDAR is SEDAR. Those are all free websites. And if you want a website that I think is fantastic for insider selling that you don't need to pay, it's CanadianInsider.com. Again, this will all be on the website. And what we subscribe to is something called Inc. Research, which is a little bit better, but you have to pay for it. And that tells you exactly options and who's exercising warrants and who's selling the insider stock before it gets published on CanadianInsider.com. So why is this important? Well, if you're selling, you want to be ahead of the curve on the selling. Okay, you got to think opposite in your mind. And when you're a buyer, this is if you're really bullish on the stock and you like it, and you understand that, hey, I've spoken to management, I know that this is happening, this is during the time you want to buy. And the irony is it's the same stock, but by waiting a difference of 2 months, you can make money, or you could be paying such a difference here. So it's because these juniors are so thinly traded, these little things make a big difference. All right, a newsletter recommendation or institution research initiation recommendation. So I know guys out there that all they do is subscribe to newsletters, not for the buys, but for the sells. Okay, that's the exact opposite of what most of the people in retail do. But what they do is, because of the trigger effect, when a newsletter writer sells and says, you know, whatever, we're discontinuing research or sell patiently, most people just put in a market sell, and it becomes so oversold that day that they do their diligence or know the company ahead of time, and they'll buy a ton of the stock and it'll naturally rebound. So they're going for the bounce effect. Also, if you know what the key of what we believe in is being ahead of the herd, if you see that your stock trades 100,000 shares a day, and all of a sudden it starts trading 500,000 shares a day, 1 million shares a day, and you see that, you know, Sprott Asset or, you know, BMO and Haywood and Canaccord start coming out with big research initiations, you know that a lot of new money is coming into the stock, so you want to light yourself, you want to reduce your position, and when that momentum ends, you're going to be able to pick some up because of the supply and demand of paper in the market. Okay? Now these are key because the junior market is so illiquid, it is very short-lived. And that's why a few conferences ago, there was a lady that came up and she said, I love what you guys do. I'd love for you to I want to subscribe to this. And I kind of started talking to her, asking her about her situation. And she was about 67 years old. She was retired and she wanted to have some fun with this. And I said, well, you know, this is really, time is an essence here. You know, when we do a private placement, you know, do you check your emails regularly? Like I have a BlackBerry or Louis has an Apple, and I know exactly what's going on minute by the minute. She goes, oh, I don't have email. Well, it's probably not the right thing for you to be in an alert service. And the reality of these is if you're playing these junior risky stocks, especially, you know, private placements and all that, you want to be hooked up to an iPhone or a BlackBerry because it's access to information. And when you want to get into a stock or sell volume, you know, you can get a Bloomberg app for free on your phone, and you have a 15-minute delay. You can pay for an upgrade to have second-by-second update level 2, but for free, you have a 15-minute delay, and you can look at your stocks during your break or whatever. So use technology to your advantage, because liquidity is a big risk in the resource sector. All right. When a newsletter or institutional firm put out a sell signal, again, I talked about that. That's part of part 6. So you want to pay attention to this. The savvy investors look only for these types of things. And you saw a question I brought up to Miles from Silvercorp was people really tried to play around with this whole concept. There's guys out there who are professional shorters, and they'll put out negative recommendations, and it'll cause a shortfall, or what we call a limit loss risk, where people have limits set, stop losses, and it'll trigger those stop losses, and a stock can go down 35, 40, 50% in the junior resource sector. So if you know you create a hit list and you look for these opportunities, it's easy to buy, but to sell all depends on liquidity. All right, this is something that you really need to pay attention to. Expectation of a positive pre-feasibility study, a bankable feasibility study, significant drill results, and violations and lawsuits, okay? So there's a famous thing called buy on rumor and sell on news. So when a junior resource company thinks they're gonna have good drill results or a big 43101 resource, they go around Vancouver, Toronto, Calgary, San Francisco, New York, and they say, you know, we're really got VG in the core, and they put a photo of the core on their website, and the stock gets excited, and people are willing to do that. Really what happens is most of the time when people are doing that type of stuff, and wink, wink, nudge, nudge, that's when you want to buy on rumor and sell on news or stay away from it because it's over being promoted, okay? If, generally speaking, if you know about something big and you're not under strict trading blackout period from the company, you're not the only one who knows about this rumor. So, you know, selling into the hype, don't fall into that trap, okay? A lot of people in the business fall into that trap. Understand the difference between a disclosure issue with the securities exchange and a technical violation, okay? You can make a lot of money buying and selling, understanding the difference between disclosing improperly and a technical issue, okay? So these are the different types of buys and sells recommendations that you can have here. So if a company is announcing that they're gonna have big results and you look at a 12-year payback and they need $1,700 gold, and they told everybody it was going to be $1 billion capex, but it's $4 billion capex, and they have a 9% IRR at, you know, spot price of gold, and they say that it's a positive bankable feasibility study. That's not very positive. So you got to be very careful on these types of things. Follow the insiders. If you like a company and more than one insider is buying large amounts of stock from the market, they know something that the market hasn't figured out yet, and you want to pay attention to that, okay? If one or more insiders are selling large blocks of stock into the market, you want to pay attention to that also. You want to understand why, okay? If one insider is selling and you want to find out, call them. That's totally plausible, and they'll tell you why. When they go into, when you go into CDAR and file your insiders, there's no clause saying, because I think the stock is overvalued, or I'm getting divorced, or I have to pay for my daughter's university education. There's no reasoning. They don't publish that. But you pick up the phone, you ask the IRR and go, why did the president just sell 100% of his stock? Oh, because he's resigning next week and the mine's lost money. Well, what do you think you want to do with your position? Or actually, he just got divorced and his wife is taking everything he has. That's a different reason for you not to sell the stock, right? So you got to do your due diligence on it. And all this can be found on CanadianInsider.com right there, okay? Okay, performance relative to its peers and industry leader. You got great programs that you didn't have during Doug's days, 20 years ago. You type this into Google Finance, it's free. You type in your stock, you type in a peer. Okay, usually you want to do the industry leader. For example, let's say you want to do uranium. So you pick Cameco as the industry leader and you pick your little junior, you can see the performance. And you pick a few other peers. Usually we used to do spreadsheets on this. Now it's simple. You just got to know how to log on to Google Finance. So if the peers, according to its index performance, is relative to the industry on, really underperforming, something could be technically very wrong with the stock. This may also represent an opportunity, okay? So here's an example that I was involved in all three here. We got a double here. Well, actually, a few times we did a double here because the East African Rift, I used Tullow, okay? Tullow was one of the most most successful London stories where the stock was just going insane. But yet, when I was tracking Africa oil to it, the London market didn't quite yet pick up to this Canadian junior. Well, I knew the management, went to the blocks, I went to check out the drilling. I know the management team, it's a Lundin group of companies. So because it was so undervalued, when I compared it to the peers, to me that was a buying opportunity. Yes. Well, for example, yeah, the question is, well, you know, how do I know what to compare it to? Well, you're not going to compare a African producer to a North American junior producer. It's got to be relative, right? So for Africa oil, the reason why I use Tullow is it was the dominant successful explorer in the East African Rift, where Africa oil was quietly picking up blocks. So you got to use a relative comp. It's peer group. Hopefully that answers the question. Yes, sir. Sure. So private placements, I should explain this before we move on. A private placement does not necessarily mean that the company is private. Okay? What a private placement means is I am buying an allocated position in the market, and I'm not buying it through the open market, which means the price changes. I'm buying a certain allocation at a fixed price. It could also be in a private company. It could be public. Okay? So for our alerts, we've never recommended in the CEC alert or CIA alerts any private companies. We have done that in one of the former alert services called the KC50. So I'll answer both questions. So if it was a private company, one example that we did was Quadrilla, which was a private placement into a private company. Now we explained the risks, but you have to go back and go, okay, look, let's work backwards. If this company is successful, this is what I think it's worth in the open market, and we work backwards going, how much money will they have to use, and then we work that way. And the company was very successful, and we got bought out. So it worked well for everybody. For Africa Oil, this was a public company that we did a private placement in twice. We did it at 95 cents and $1.05 with warrants at $1.50. And the way I did it was I looked at what I was paying for the company on a NAV value. Okay, they have a 51,101, which is like equivalent to a 43,101 in mining. And I worked backwards going, well, let me look at everything in Kenya, in the region, what it's going for. And I figured that, you know what? Once the market does get the story and they can JV out these projects, I said this is at least a double. So that's how I played the Africa Oil. So when people asked why we sold, because now it increased significantly to the peers, and they haven't drilled a well yet. They're in the process of drilling. So that's two examples of how we valued. And we go through the APs, and I wish it was that easy, but we do spend time on it. So examples of the past, Poseidon was trading significantly under. It popped up. Now it's at the normal range for the service companies. And I was an insider and director of Copper Mountain, and for the longest time, it was completely undervalued to Taseko or any of the BC peers. So I would use the BC copper producers, the lower grade copper producers, as a peer table to that. That's how we did it. And you do your due diligence and you base it on that. So name change to capture the flavor of the day momentum. Okay, 5 years ago, uranium was insane. There were companies that were being bought offers at 2-3 times valuations. They said no. Management were so sure themselves that this was big. And then about 2 years ago, those uranium companies became rare earth companies. And now they're lithium companies, or today they're changing into graphite companies. Okay? So out of respect to my old buddy Jeff, if a company changes its name from Jeff's Gold Exploration to Jeff's Rare Earths Inc., probably time to start reducing your exposure to that stock and look to secure your profits, okay? Great management teams don't follow trends, they follow value and create trends, okay? You'll never see Ross Beatty or Lucas Lundin follow a trend. You won't see a Jim O'Rourke follow a trend. They do what they find value, and other people create a trend around them. Story changed. You know what? I probably have more losers than anyone in this room, but sometimes you got to cut your losses and just focus on the winners. If the PP you invested in or bought in the open market was raised for drilling a copper project in BC, and now the company wants to spend money and buy a gold project in Colombia because the project in BC didn't succeed, and now the share structure isn't what you originally wanted, you got to cut your losses and leave. If the reason you invested in the story didn't pan out and it changes, don't change your investment philosophy. Okay? Now buyers, this is a buying opportunity now. This presents a refinancing opportunity post roll-up if the 8Ps are all positive. So if you like the management team, and look, they did their best. They drilled a theory. Remember, geology is kind of like it's the art science. There's no guarantees here. And they say, look, Lucas Lundin has done a roll-up many, many times. Africa Oil is actually from a failure. Marin is the failure of Bayou Bend. We doubled our money on Bayou Bend because it was a failure. So people are going, how the hell did he make money off a failure? I went to the projects and I said, you know what? This is the valuation, success is priced in for Bayou Bend. So what happened was it had a $2 valuation. They raised a whole bunch of money. Bayou Bend's the story of Frank Juster and Lucas Lundin merging for the first time. They raised $300 million. The market went gaga for this. I went on the trip, did my due diligence. I said, you know what? They got to hit like 70% of these wells to get this valuation. So I just hung out, had fun, didn't recommend it. And we recommend it when it was trading 50% cash. A Lucas Lundin company was trading at 50% cash. So we did the recommendation, the CEC alert, and at that time it was Bayou Bend. They rolled it up, they refinanced it, and then it ran from the 15 cents to over $1 in Marin, and then we closed our position. So this is also a buying opportunity if the 8Ps fit, okay? If the story changes. Geos who plan on building the mine they found. You would not believe how many guys fall in love with the project and can't let their baby go. This is a big, big problem. I don't know too many geos who can actually succeed in doing this. There are guys like Rui did it, but if you know Rui, he'll chew through steel to make money. You know, there's very few pit bulls like that. He's a rare breed. 99% of the time, when a geo builds a mine, there's a learning curve, and he's going to learn on the project, cost overruns. You rarely want to stick around for that. Remember the exploration cycle curve, the profits. Remember, people will pay for mystery and forget about history. So you want to pay attention to that. Post-discovery boredom and building mine blues, okay? Stock speculators get bored after the discovery has been made and the resource is tapped because reality sets in, and I call it the pregnancy period. So if you go back and study this, there's the 9 months before the stock goes to production that speculation starts. Is it going to be a pretty baby? Is it going to be an ugly baby? Is it going to be my baby? You know, all these different questions. So pay attention to these things. Now, this is a buying opportunity for yourself because you can buy and flip back to those speculators. A lot of this investment is based on timing, okay? I'll give you a perfect example. One that was one of the largest shareholders and still have a significant position in was Copper Mountain. You can go and see the insider filings on what I've done myself. I came out strong as one of the largest investors personally at the age of 27, okay? IPO, I was gung-ho, it was sexy. I bought stock as high as $2.75. Within 12 months, it was trading at 33 cents, okay? People, good friends of mine, the chairman of Haywood would take me out, go, Marin, you're going to blow yourself up. I did my due diligence, did the 8Ps on it, sold my apartment to cover more stock, okay? I don't recommend that you do that. But, you know, the reality is nobody cared. Nobody cared. It was really sexy when we were doing exploration and proving up the theory of the Titan 24, creating the 3 pits to join them to the super pit. But it went to 33 cents. We had 57 cents cash per share. Okay? Within 24 months, it ran to $8. Okay? So you got to pay attention to these things. And the only time you make money is when you, that's right. Okay, this is my own, I made up this word. I don't actually know if it's a really word. Management become polygaventurists. Okay? There's a certain area in BC which, you know, many polygamists in BC inhabit. These venturists come out during a bull market. You know what? You want a lithium deal? I'm a lithium CEO. You want a copper deal? I'm a copper CEO. You want graphite? I got one right here. You know? You want gold? Right here. Be careful of that. You don't want a guy who's just working for you on Monday morning before his first coffee, right? Now, what's really important is you can check all this out on the internet. You just do searches on the guy's name. If he's an insider on 15 companies, he's a president of 7 different junior explorers. Why? okay? So really pay attention to this. But how can you make money on this? That's what we all care about. When a polygaventurist in a bull market is hot, he can raise a lot of money. But you keep that on your radar screen because he'll do a financing at $1. It's happened before in every cycle. These guys excel at this. This is where cash boxes come from. So you pay attention to a polygaventurist and you know that you'll be able to buy the company for maybe 30, 40, 50, 60 cents on the dollar. Just pay attention. On November 2008, I published this in our CER, and also I went on BNN to talk about it. I came up with 5 stocks that were trading at less than half of the cash in the box, okay? And if you bought that within 12 months, the worst you would have done is 3 times your money. So pay attention to these, because cash is still cash. A major director or management person leaves, okay? Just because you like the stock, that means nothing. You have to make sure that the guy who knows the stock better than you likes the stock. So if a director is one of good standing and has a past of success and good reputation and resigns for non-personal reasons, meaning, look, if the guy's dying of cancer or his wife is ill and he wants to take some time off, that's a different story. But you phone the company and you find out. But if the guy has a serious issue and he resigns from the board, he's covering his own ass legally. That means something down the road is happening. You want to pay attention to this. Usually a sign that something is wrong. And if he's selling his stock, you go back to CanadianInsider.com, you probably, after you find out and do your 10 minutes of due diligence during your coffee break, you can save yourself a lot of headaches. Okay, a Casey True Netback. All right, so I get a lot of heat in the market for, creating the Casey free ride, and I got a lot of brokers and fund managers and company management that give Louis and I a lot of headaches. Oh, we don't want you coming on the site tour because you're just going to do a Casey free ride, And they think that, they should sustain their lifestyles through these public companies. And the biggest myth right now in the energy business, and I've written many articles about this, is barrels of oil equivalent, okay? When you see BOE, that is the biggest scam I've seen in the energy business, and I can't believe that the Securities Exchange allows it. For example, a barrel of oil is not the same as a barrel of oil equivalent. But because the juniors, when they talk about gold equivalent and, they have some silver and some copper and they just say asterisk gold equivalent, that doesn't quite work because the energy equivalent is 6-to-1 ratio for oil to gas, okay? So you take 6,000 cubic feet. So you look at that and say, what's gas right now? About $2.50 per MCF in the US. Oil is at $100. You're looking at a 30-to-1 difference. And they're allowed to get away with this. So be careful for that. Another thing that I like to talk about is the Casey True Netback. As a shareholder, what is your true netback? I sat beside the number 1 or number 2 largest energy fund manager in Canada on Friday on an airplane. And we were talking about my article on Canadian oil sands, the differentials, okay? Just because oil is $100 doesn't mean your oil company's getting $100. And the difference between a field netback is how the industry reports and what the company as a shareholder, after you reduce their MD&A, after you reduce their salaries and bonuses and legal fees and all of their costs, all you care about as a shareholder is this, a Casey True Netback. Now, we publish this every quarter as the top 10 true netbacks, okay? So when you're buying an oil and gas producer, do not use field netbacks because if they have huge debt on it, you're not making anything. So be careful on that, okay? Now, how does that become a buying opportunity? If you start tracking these companies, you can figure out which ones are true earners. Because if you're just tracking a field netback, you're not looking at all the different costs. And you can identify the actual best performers per share. And we do that for you. Okay, here's a big one. Walk around the aisle and, what I did was we reworked all of the companies here, their cash positions, so I don't really need to necessarily talk to the IR person. But if a company budgets exploration but needs to raise cash for that, you ask them, we're going to do 20,000 meters of drilling, but we got 600 grand in the bank. They're going to have to raise money. And in this market, that means at a discount to the market with full warrants. And in a bear market, it's very difficult to raise money for junior exploration programs. So a cash box, I think I published this like in September or October, how important, what Louis talked about, the cash in the bank is more important in a bear market than ever before, because it's all about the share structure, integrity, okay? Now buyers, this may represent a major opportunity, because when I see a company less than $2 million, my mouth starts salivating, because I'm thinking, great, full warrants, here we go. But the APs have to go through, okay? So just because the company doesn't have money in the bank right now and you don't want to buy it in the market doesn't mean in 3 or 4 months that you won't buy it, because if the people are good and the project's good and all the APs are good. So this is also a buying opportunity. It's all about timing. Exploration failure. The reality is not all drill programs will be successful. It's not the management's fault. It's no one's fault. Look, you cut your losses, take your tax loss, and don't chase good money after bad money. I learned a lot on the geothermals. I lost more money in this room than anyone on the geothermals. Don't hope that somehow it gets back to the price it once was. Hopes for church. Especially if management rolls back the stock, etc., and management move on to do something other. Again, we go back to rule number 7. That might be something to move forward to, okay? But if it fails the exploration, it's failed, okay? I've had many of these. Don't wait for the official takeover date to close. There's professional funds that play the arbs on this, okay? We did this with Tanganyika Oil. We just sold. And we bought it again in the newsletter because people didn't think that it would close. So there was a $3 differential. A lot of times when there's a takeover target, let's say the company you're invested in is trading at $4 and they get a takeout offer at $6.50 and the stock will pop to $6.25. Do you really want to hold that stock for another 25 cents? We've done this a few times in the newsletter. Hathor is the most recent example. We were a little bit earlier. We could have got another 50 cents, I believe, on it if we held on. But I didn't think the risk was worth it. So those are the 20 rules. Any questions? This will be on the website. No questions? You guys are all tired and bored? Louis, guys, this is, I want to congratulate you guys for coming here, but this is why you're here. Ask us questions. Yes, sir.
Is this on? Yeah. I'm not sure exactly what your question is. But there is certainly controversy over mining. And there are people who are ideologically opposed to mining. There are people who are ideologically opposed to any industry. And these people will come out of the woodwork. It's interesting that you mentioned the Congo. In the current issue of the International Speculator that just came out last Thursday, I wrote about that. And I wrote about people that I saw 5 years ago and saw 4 weeks ago, and the material difference and improvement in well-being in their lives. It's interesting that if you were here earlier today, you heard Keith mention how the mine opens up in the town, the population booms, it's a bunch of young men, miners who work there, and suddenly there's alcohol, prostitution, drugs that weren't there before. Obviously, whenever there's any kind of big economic change in an area, there are going to be adjustments and changes. I can tell you from personal experience that I have seen several before and after pictures. I don't know if I could count how many before and afters. Most things I see only once, but I've seen a good number of before and after pictures where I have seen places that were desolated. There was nothing there, and the people were essentially scrabbling in the dirt. And then I come back later, and the mine is there. It's built up to modern environmental standards, and it's a clean operation. In many cases, it's actually cleaned up a mess left over by informal, illegal miners before, and the people have, work with dignity. But the really interesting thing is actually the surrounding village, in spite of what Keith said, and I'm sure there's been a miner somewhere that's raped somebody in the Congo. That probably has happened. But if you look at the surrounding villages, you see all the restaurants and hotels that weren't there before. you see not just the miners that have the jobs, but you see the economic impact on the community, and it's huge and it's positive. And you've got people, and it sounds like I'm exaggerating, but I'm not. I mean it literally, scrabbling in the dirt, who now have cars, or at least mopeds, and you know, have a chance of betterment, and their children have education and have a future. And I believe very strongly in this. Yes, there are bad guys in any business. But the world needs its metals, it needs its resources, it needs its energy. So the essence of the business is to provide goods that are needed by our entire species. And when people do it properly, then it benefits even the local communities as well as all kinds of third parties. It's an absolute win-win-win thing. It has a maligned reputation. I think a lot of that has to do with history. There was a time when there were no environmental standards to speak of, and you could throw all your mercury and trash in the river. That did happen. But that's not the mining of today. So there are people that get it. Perhaps the governor of the province of Quebec is one who really gets it, and he's going around, he's trying to attract investment. There are people that don't get it. You know, they see the negative press. There's a website called nodirtygold.com, and there's negative press out there if you want to find it. And people, I get emails. I get emails from friends and family who receive some chain letter about stopping some mining project or another, and they write to me because they know I know something about mines, and they hear these scary things. And it's amazing, you know, the amount of disinformation. I was in one place in Ecuador where I met villagers where the village elders were being paid $1,000. I forget the time frame. They were being paid $1,000 a something, which is a lot of money for a village elder, to oppose the mine project. How do I know that? At the time I had very long hair, and I went in to interview the opposition and the activists, and they said, "Oh, you're one of us. Come in, brother." And they told me what they were doing. They told me which 3 projects they were going to focus their opposition on, and they told me what they were paying the village elders to oppose the project.
You know, but like when you talk about Jean Charest, he's the premier of Quebec. He was actually supposed to be one of the contenders for Prime Minister of Canada. He was a conservative, and when Quebec had whether they were going to vote to separate from Canada, Quebec wasn't in a good spot. You know, the jobs and the dollar at the time versus the U.S. dollar, and this is a great case study of a province that is really trying to generate itself from its resources. Alberta is another example. You know, when Trudeau, with his national energy program, basically nationalized, the province shut down. You travel to northern Alberta right now, in Fort McMurray, you know, a welder with a 24-month certificate at a community college can be making up to $350,000, $400,000 a year right now, and they're signing 5-year contracts for the pipelines. Okay, now you look at these regions, you look at, you know, what created and what provided the value for the massive infrastructure in BC. It was all mining. Okay, it wasn't the national parks that they put in now. Okay, so it will come with time and education. And you look at, for example, a project I was involved with, the Copper Mountain. It was the first mine in 16 years put into production. You know, we took these kids and we walked through, just like we did with a bunch of the Casey subscribers, through the mill, and these kids were excited, they were happy. But you see, this isn't taught in the education system because it hasn't happened for so long. And there's an education curve to it.